Steve Brice is Chief Investment Officer, Standard Chartered Wealth Management. He's joining us right now. Steve, good to have you with us here. Thanks for your time. Is there any is there a debate arising once again on where the neutral rate in the US is, whether the first action from the Fed will indeed be a rate cut? Could it be something else? Or is that a settled issue now, Steve? I'm asking because of the string of data that we've got.
Yeah, I mean, obviously there's some strength still in the economy, and obviously we're seeing that inflation prices paid component, particularly from the ISM, leading to some concerns that maybe inflation will not come down as quickly as anticipated. So, from our perspective, what we're sort of alluding to is we think that the first rate cut will probably be in June of this year, not in March. We think the disinflation cycle is pretty set. We do need to watch what's obviously going on in the Red Sea. And the impact of the rerouting of trade, both from a growth but also from an inflation perspective. Just keep an eye on that. So we have added a bit of inflation hedges into our portfolio in the past couple of weeks, just to monitor that short-term upside risk to inflation. But overall, it does seem very, very likely that the next move is still to the downside for US interest rates.
Okay, next move is to the downside for US interest rates. That seems to be the case, Steve, with the Indian interest rates as well. We just don't have clarity on timing, right? We have the RBI policy tomorrow. What is your expectation this time around, and how are you feeling about India in general?
Yeah, so from a monetary policy perspective, our sense is that obviously that they'll be unchanged tomorrow and maintain the withdrawal accommodation stance. Obviously the focus then will switch to this policy statement thereafter. We've seen the 10-year government bond yield obviously drop quite significantly in the past few weeks. I think the central bank will want to see further progress on inflation coming down before they shift that stance towards looking towards easing policy. But overall, that seems to be the trend around the globe. India doesn't seem to be an exception. Although it might be with a slight lag relative to somewhere like the Fed.
Hi, Steve. Good morning. Nigel on this side. Good to see you in after a while. What about the Chinese markets? The economy was in turmoil. Now the markets as well have plunged big time. What's your view out there? You wait for things to settle down out there, or you say, well, valuations are in your favor, so try to allocate some money. How do you look at it?
Yeah, so I mean, from our perspective, obviously the market is extremely cheap and is massively oversold. In fact, I was doing an interview on Monday morning with CNBC Asia and talking about the volatility, and the level of questioning was becoming increasingly bearish and pessimistic. And we actually discussed that maybe that's an indicator of a short-term low being put in place. So, we're neutral Chinese equities. We're worried about the fundamentals. The headwinds seem to be very significant from the growth, regulatory, and geopolitical side. But then valuations balance that off, and this extreme pessimism. So, I think to get a very long-term bounce, like a 6 to 12-month bounce in the Chinese stock market, we need to see further policy actions. We probably need to see inflation bottom out and recover. But you could see a 1-2 month recovery from depressed levels and lead to pretty strong performance in the short term. So we balance that out as a neutral allocation within our Asia ex-Japan piece. But we certainly wouldn't be underweight at this stage.
All right. Thanks a lot for that. You wouldn't be underweight at this stage. Got it. We'll let